Ankur, let me in fact go across to Punit Bahlani, who's joining us from Dolat Capital. He's the BFSI lead at Dolat to talk to us about exactly that. Hi, Punit. Good having you. Punit, talk to us about the larger impact here. PSU banks are obviously the banks which are going to be more impacted among the larger cohort of banks. But talk to us about how much of a hit do they take broadly.
So see, in the context, there are two hits one you need to monitor. One is the hit on net worth. That for all banks is around what has been disclosed, around 7 to 10%. This is based on, credit rating reports. And in the past quarter, when the draft norms were released, the PSU bank released their own calculations, and on calls, they reported that 7 to 10% of net worth is affected. Now, yes, there is a transition period. 4 to 5 years, the capital consumption is not much every year, and plus the capital position is also comfortable. You have on an average the PSU banks tier 1 are over 13% plus, and if you include private banks for the entire industry, it's around 15% plus. So capital hit is not something it's not something to bother about. I think it's easily sustainable, whether at one go or whether in a transition base you do it. The more impact is on the incremental flow, the incremental credit cost that will be charged to the PNL, that gets impacted, and that affects your ROAs. And that the street was expecting a watered down version of this circular, the flow rate, but RBI has kept the flow rates unchanged, which means that if even as per your ECL model you are having lower provisions for stage 2, you have to carry the floor. Okay, and that is in a way more negative for PSU banks, because they don't have any contingent buffers available with them. So there is the large impact. Now, what is the impact, whether it's 15 bips, 20 bips, 25 bips? PSU banks are the best judge for that, because the data, it takes into account the data, the 10-year data or 15-year data, whatever the tenor is, the recoveries that you have had, the defaults that you have had, and accordingly, you build a model and calculate. But private banks are more insulated here because of the balance sheets being more insulated. They have created contingent buffers, whether you call it for ECL or for another any other aspect which is unnamed, but they can use that and be insulated from this.
Right.
That's where the impact is coming. Yeah.
Right. Punit, one quick follow-up with regard to the private banking pack. Which are the ones which will be worse hit versus others? For example, I know for a fact that ICICI has a provision buffer of around 13,000 crore. HDFC has a provision buffer of roughly 25,000 crore, which can take care of some of this. Give us a sense of which are the banks which will be the worst hit.
So see, two aspects again, HDFC, ICICI and Axis, all the three have created. Axis recently created a contingent buffer, although yes, that was for the West Asia conflict, the purpose, but they also had previously they had some contingent buffers in the balance sheet. So these three, they can at least handle, or, relatively better positions to, are in a relatively better position to handle this. Because they have contingent buffers. Banks like Kotak also don't carry any contingent buffers, or very negligible contingent buffers. So they will be impacted. You have mid-sized banks like DCB, RBL, who haven't created much provisions. Even banks like City Union over the past 2 quarters, they created some provisions, but not enough. I don't think that's enough for the entire to absorb the entire impact. So based on now the second factor that comes in here is the loss given defaults. How much you have to carry on your balance sheet, which will be based on your past recovery efforts and the way your NPS trended, and all that will also affect. So bank wise, there is going to be a separate, impact, which is difficult to judge that which bank will be here. But on a pack, because the past LGDs were high for PSUs, you can say PSUs will have a higher impact compared to private. Within private, of course, it will differ based on the asset quality experience they've had in the past.
In terms of PSU banks, what's the one-time hit looking like, and what's the recurring ballpark? Is it 20 bips broadly that we can expect across banks?
So, see, on the recurring ballpark, BOB in the 3Q con call had highlighted around 20 bips. So if you take as a base, say SBI, and say SBI has a better exposure, like best asset quality experience than BOB, it might be 15 bips or something. So this word on the street is 15 to 25 bips, but this is, we'll get more clarity from the banks itself in 4Q. But based on what the street is thinking is that 20 bips was what BOB highlighted in 3Q. And around that, people are expecting around 15 to 25 bips. Either way, even if you take the lower case of 15 bips, that makes it difficult for the PSU banks to report 1% plus ROAs. On the net worth hit, it's 7 to 10%. But that will be 7 to 10% was what they had reported in 3Q for for the entire PSU pack. Private banks, of course, it's much lower. But that will be offset by the risk weight reductions that have happened. So the second circular, where RBI has reduced risk weights on certain corporate exposures, on home loan exposures, on mortgages, SME LAP loans. There they will get some capital release, and so the net impact is to be considered, which will be less than the 7 to 10% in my view. And they have 4 to 5 year buffer, to implement that. Like for 1/5 of the impact needs to be taken every year. So that way, there is sufficient capital buffers available. I don't think that is going to be much of a concern. It's mainly on the incremental flow. Yeah.
Punit, so good having you on the show, and we would have loved a much longer conversation, but Maruti's numbers and very disappointing ones in that, so got to address that. But thank you so much for your time today.